Hello, everyone. I am Matt Stranix, and I want to welcome you to the inaugural episode of 5 Minute Finance, brought to you by SFS Wealth Management. This is our brand new educational video series that answers your questions on common financial topics. New videos will debut on the first and third Wednesday of every month. Feel free to like, comment, and share to help spread the financial education. This week's episode features our very own Luke Chapman.
Hi, everyone. Thanks for tuning in.
Luke, a common question that seems to come up with both clients and prospective clients is, why should I have a mortgage in retirement? My mortgage is my largest fixed expense each month, and I'd rather reduce those fixed costs in retirement. Let me hear your thoughts on this.
Thank you, Matt. And that is something we've been asked a lot recently. I'll give an example. Obviously, there could be many different components and ways to look at this, but we only have time for one example. In our example, I'll use the name Jill. Jill is about to retire. She has an existing home worth $350,000 that has no outstanding mortgage on it. She is planning to sell that home and use the proceeds to buy a new retirement home in full and therefore have no mortgage in retirement. One of the things that we should know about Jill is that her fixed income in retirement will be Social Security and a small pension. And yes, that is enough to satisfy her lifestyle needs as far as she's been able to anticipate for her retirement lifestyle, food, car, gas, a little bit of travel, healthcare, those sorts of things. But that fixed income wouldn't really afford much else, or the ability to save from that fixed income. And so the idea of having no mortgage was really the only way that she thought that she could move. Her existing home is old. It would require a lot of upkeep. It's not around any family and friends anymore, and the layout isn't right to age in place. So moving definitely makes sense, and we wanted to make sure that she could do that in the most efficient way. So if she sold her existing home at a value of $350,000, she'd probably take away a net remaining proceeds of about $325,000. If she bought the new home at $300,000 in full, therefore having no mortgage, she'd leave herself somewhere between $10,000 and $25,000 remaining, and that's not if she didn't have to replace all the furniture and use up the money. One of the things I like to talk to people about in this scenario is equity, which is a non-spendable asset, versus savings, a spendable asset. With Jill's original plan of having no mortgage, she would have had lesser expenses, but no savings. See, one of the things that we didn't know about Jill is that she didn't have any other savings. What the proceeds of the home sale would have been her only savings. So in the event of an emergency or some increased expense in retirement, she would not have any savings to go to that she may need beyond what her fixed income is bringing in each month. So to access the equity, the value of the home minus any outstanding debts, what can we do? Well, Jill would have been forced to sell, but then where would she live, or take out a home equity line of credit? Well, in Jill's example, the home equity line of credit, though borrows against the value of the home, would still need to be repaid, and her fixed income would likely not afford her enough to then make those payments, and she would have a problem. So that didn't seem like a good idea. The other thing I like to talk to people about is freedom and flexibility. The freedom and flexibility of, instead of buying the house in full, mortgage the home. Put the minimum amount down. Yes, your fixed income wouldn't be able to afford that mortgage otherwise, but we've saved and invested the proceeds of your original home sale so that you can distribute what you need monthly to make the mortgage payment on the new home, but also still have all of those spendable assets to cover any emergencies or additional expenses in the future. And if you wanted to accelerate the payment of that mortgage, you get a few years down the road, maybe you wake up on a Saturday morning with a cold sweat. What am I doing? I have a mortgage in retirement. You take what's left in the savings and then you pay off the remaining balance in full. Matt, I hope this helps. It was a good conversation with Jill. It ended up being the right thing for her to give consideration to having a mortgage in retirement. and not a blanket statement for all. Obviously, the other components of your financial world come into play here, but we would challenge somebody to maybe consider the value of a mortgage versus no mortgage in retirement. Thank you.
Excellent. Thank you, Luke. That wraps up this episode of 5 Minute Finance. Make sure you tune in next time for information on mortgage refinances. What are they? When do they make sense? And why would you do it? Thanks, everybody.
Thanks, everyone.